Okay, I think we're gonna start. I'll keep an eye out and see if anybody else pops in. For now, I want to introduce myself, Phyllis Cangro from DiTommaso Real Estate. And on the call with me is Joe Curcio. He's from Federal Savings. And, right, did I get that right?
Yes, yeah, I'm a senior vice president with the Federal Savings Bank, so I'm the mortgage specialist.
And I'm on also want to introduce Anthony Esposito from Esposito Law.
Hello.
Okay,
Good evening,
so
everyone.
so our team is dedicated to helping you find the perfect home with ease and expert support. Tonight, we're going to go through home buying made simple, the financing overall and loan process, making an offer and getting it accepted, everything from contract to closing and closing and beyond. Hold on one second. Oh, I thought I saw somebody come on. Okay. Okay, we will provide you with helpful information for before, during, and after your transaction. Our business model and is really all about you. Okay, so searching for a home. Let's get started. First, we're going to ask you guys to, when you're starting to look, you should start looking online and do neighborhood drive-bys and stuff to see where your location preferences are. Do you want to be close to the Verrazano Bridge? Do you want to be closer to the Outer Bridge crossing or Goethals Bridge? Do you need to have easy commute to the ferry or to express buses? Thank you. Do you want to be closer to the parks and stores? Is that important to you? So you want to really get an idea of what kind of house you're looking for and what area and proximity of key destinations that you want to be in. The next thing you're going to do is figure out your financial status, like where your price range is for looking at houses. And in a little while, Joe Curcio is going to get into the mortgages and we could get into that. The next thing I'm going to tell you to do is take a piece of paper, split it in half with your wants and must-haves. Do you want a three-bedroom or must you have a three-bedroom? Because your wants and must-haves are two different things. Must-haves means you cannot negotiate those things away, but the wants you could kind of negotiate. Do you want a pool? Or do you have to have a pool? Stuff like that. Um, then after you get to that point, you're gonna make an appointment with me for a consultation where we're gonna sit down and go over everything. Go over your finances, your price point, what kind of house you're looking for, what your wants and needs are, and we'll set you up on the MLS. And that's when you'll start getting houses that are on the market every day. About 7:30 they come in at night. And then every morning I look at the hot sheet and I look through everything that was sent to you. And sometimes you might miss something or you were busy that night. So if I see a house that I know is going to be perfect for you, I'll send you a text and say, you might want to take a look at this. Let me know if you want to see it. So that's how we go from there. Okay, so now we look at all the houses, we find some houses that you want, and we're going to make an offer. When you make an offer, the seller has three different ways of looking at your offer. They're either going to accept it, they're going to counter offer, or they're going to reject your offer. So to make sure that we're prepared so we don't get a rejection, I will do a customer market analysis on the home. That means I will look at the house and I will look at all the houses around the area and see what they're selling for that's compatible to the house we're looking at. We're going to look at the terms of the house also. Does it need work? Is it upgraded? What's gonna come with the house is are you gonna have the appliances stay and the fixtures stay? What are the terms? Does the seller need to find a house and we have to give them time? Do you have the time to give them time? Or do they need a fast closing and can you give them a fast closing? So we'll discuss all of that as we find your house. Um, then we'll write up the offer, and when I write up the offer, it'll be on Dotloop. I will send it to you electronically so that you could sign it. We don't have to get together for the paperwork all the time. We could do it just like that. So I also have to get compensated. As you know, there's a new law out there, rule that buyers need to get paid by buyers agents need to get paid by the buyers. That's what's going around the news. That's not really the case, and I wanted to bring it up so you could understand how it is. Um, when I speak to an agent of a house that we're interested in, I'm going to ask them if the seller is offering a commission to the buyer's agent. Most agents are talking to the sellers and explaining to them that it's still a good idea to offer the out a commission to a buyer's agent because in reality, it's still going to come out, the commission's still going to come out of the proceeds of the house. So it's either going to be that the seller's going to offer the commission or we're going to write it into the price of the house. Or we're going to do a seller's concession, which something Joe could get into later on because that has to do with the mortgages. Or we're going to offer less where you're going to write me a check. So e- whichever way it's going to be, it's still going to come out of the proceeds of the house. It's just which way is it going to come out of the proceeds of the house. My goal as your representative is to get you to pay the least amounts of commission and hopefully nothing. So now we get into financing. This is where Joe Curcio comes in.
Fantastic. Thank you, Phyllis. Would you mind just going to slide 15 for me? Let's skip over 14. Um,
Just let me know where
yeah, right
because
there. Perfect.
okay.
Perfect. Good evening, everyone. Thank you so much for coming on to this, Phyllis. Thank you for setting this up. This is awesome. I'm excited. So as Phil said previously, I am the mortgage specialist. And just a little bit about me. I am the senior vice president in my division, my company. So I am a direct lender. I'm local. I'm on South Avenue in Staten Island. Even though I'm local, I could do all 50 states of lending. And the way my bank operates is I am a direct lender. We have in-house financing, but I also do have the ability to shop between, let's say, 30 different banks, so I can make sure that I'm getting the best program or interest rate for your specific situation. And I'll go into a little bit later of what it actually means to qualify for different programs or rates based off of your scenario. So, purpose of my portion right now, the finance, is just to kind of just want to get you guys kind of open the idea, know what questions to ask for going into the home buying process. Um, the biggest part is going to be the beginning, the pre-approval, how we're getting qualified. The later steps about, what's after that, when you get into contract and all those good things, we're definitely going to touch on, but definitely something that, let's say we do get to work together and you find a house, I'm going to I'm going to keep putting it out there and keep saying, hey, this is your next step. This is what we have to focus on. I don't want to just dump all this information on you and you say my head hurts. So we'll keep it nice and simple. So, pre-approval. So what does it mean essentially, right? You might have an agent ask you for a pre-approval if you went and just walked in an open house and you were thinking of the property. Maybe you didn't want to put an offer, but they're going to ask you if you're pre-approved. So 9 times out of 10, when somebody's looking to buy a house, they go directly to the real estate agent, right? So the real estate agent finds the house. Um, After that, if you haven't already sat down with the bank, they're going to push you back to someone like myself as a mortgage lender, basically just to see where you're at, right? Because, we all look online and we see, there's a house at 600,000, I can afford that. That's what I'm going to go for. But we don't really know the logistics of it. My biggest thing is to make sure that you know what your monthly payment is going to be, because we live in the monthly payment, and what your out-of-pocket costs are going to be. I can't stress enough what it means to put all your expenses and everything on paper to see what your availability of funds is and where you're comfortable spending. So it like leasing a car. You don't care about the MSRP. We really focus on the monthly payment. So I'm very, very big on that. So right here in this qualification for mortgage, there's four different things listed, right? Principal on a loan, interest on a loan, property taxes, homeowners insurance. Um, what that makes up is your monthly payment. Now, before going into, let me check these slides to make sure where I'm going to tell you about the pre-approval. That's going to come, okay, that's going to come in a few slides. All right, perfect. So we'll work it a little backwards. So when we're going over monthly payment, we're going to look at what your loan is actually going to be, right? So let's say you're going for a $600,000 house and putting, 10% down, right? You have a 550 loan amount. I'm going to price out to see what a 550 loan amount is going to give you in your scenario. If you want to do a 30-year term, a fixed term, I'll run with your credit and the property you're looking to get, and that can get a good idea of what that principal and interest payment is going to be. All right, that's the main bulk of the mortgage. That is the mortgage. Now, the other things that we can include in the mortgage is your homeowner's insurance and your property taxes. So when you're going and buying a home, obviously, let's say, we're in New York. New York, we have taxes, right? We pay state taxes, just as what it is. So let's say you have 6,000 taxes for the year. We can include that in your monthly payment, all right? So break it down $500 a month. And then insurance, let's say you get a home insurance policy for another $100 a month. So it's another $600 I'm adding to the principal and interest. So reason why I'm stressing this is just to identify what it is that you're making your monthly payments on. Because I have a lot of people that'll go on Zillow and just play around in the calculator and say, oh, my monthly payment's going to be 2,000. And then I say, well, you didn't count for the taxes and insurance. Where where are you counting for the extra $800 you have to pay? So it's just always something good to keep in the back of your head. So that's as far as monthly payment. Phyllis, can you go to the next slide for me, please?
Sure. That good?
Can you actually go to slide 18? I want to bounce back to this one.
That one?
One more. Okay. So the pre-approval process. I should have put that principal interest slide after this one, but it's okay. Bear with me. If I talk too fast, please stop me. I get excited about mortgages. Strange, right? So the pre-approval process. What is it? So what we do is first we get on a phone call, and I like to do a one-on-one, just kind of get an idea of your situation, your goals, what you're looking to do, and then we kind of back into the application process. All right. So a pre-approval call, I'm getting an idea of what you do for work, how long you've been there, what your income looks like in that place, or if you're self-employed, what your business is netting. I'm gonna ask you about your credit and your credit history, right, and the liabilities you have, and then I'm gonna look at your assets. All right, so these three things are the most important things in that order specifically, right? If you don't have income, we can't make it up, right? Income has to be verified. That's the most important thing. Credit, we can always adjust. I could always help you with it. I could always run a simulator and say, oh, you know what? It looks like we need to pay this down by this much. You may make this one an authorized user, and your score will boost 40 points in a month. Third one is assets. Assets I put as the last one just because people always seem to be able to find money, whether it's a gift from somebody, whether it's pulling from retirement. There's certain things you could do that some people don't realize you can. So that's always something that we can accumulate to get to the closing. But like I said, the income is the most important thing. So pre-approval process is you're filling out a general application. I'm asking you for documents such as pay stubs, W-2s, just to verify your income. Pulling a credit report, I could do a soft credit pull, so it's not going to negatively impact your credit. If we do a full credit report, and it maybe brings on your credit score 3 to 5 points, but within 30 days it rebounds. Nothing detrimental like some people do think. It just gives me a better scope of your 10-year credit history. And I'm going to verify some assets, right? Any bank accounts you have, retirement, things like that. Once I have those things together, what I'm doing is I'm creating the application and I'm running your debt to income. Now, debt to income is what we on the mortgage side qualify you off of, right? Because I'm saying, let's say your income is $10,000 a month and you have $2,000 in liabilities. What is the income that you're going to have left over to be able to pay the mortgage? So I'm calculating all that. Bank actually looks at your gross pay instead of your net pay. So I personally believe banks lend you more money than they should. That's something we'll talk about in a later date. But that's how we qualify you to see where you would be in a price point of a house, right? So you know what your qualification is. Once I do have all that in, right? This is the pre-approval, preliminary stages. We get back on a call and we go over again where you're comfortable. You tell me that, Joe, this is the monthly payment I want to stay around. I'm going to say, okay, if we're putting X amount of money down, which you could do as little as 3% as a first-time home buyer, or you could do as much as, I mean, you don't have to take a mortgage. You can put as much money as you want to put down, as little as 3%. What does that mean? You put down 3%. Obviously, your monthly payment's a little bit higher than if you put down 20% or 50%. If you do not have 20%, do not be afraid, because 80% of the people I deal with do not have 20% down. And if they do, 5 out of 10 times their parents gave them the money. Not saying there's anything wrong with that. That's amazing. I wish my mother would give me the money, but again, another story, another time. Um, So you do have the availability to put down what you'd like to put down. But again, I like to stress where you are as far as monthly payment, where you're going to be at a pocket cost, and then we translate that to a purchase price. Once we know that, I could say, all right, Phyllis, fine, we're looking around this price range. This is what we know they're going to be comfortable in. Basically, what this does, it does two things. One, you're secure, right? If you go and look at this house and you will put an offer in, we're ready to go. We have the paperwork ready. We can put the offer. There's nothing delaying us. And two, it's going to make you more comfortable in the process. Going and looking at houses, and some people put in offers without going through the pre-approval process. Me, I'd be a little scared, because I don't know what it's going to cost me. I don't know what the end run is. I don't, you just don't know. So it's super, super important to have that pre-approval ready. Now I want to see what was on that other slide. Down
Also, just
payment,
so you
closing costs,
know,
that's fine.
at the
Yeah.
end, just so you know, while Joe's figuring out which slide he wants, at the end, we're gonna have question and answering time. And I'm also going to send all these slides over to everybody so you could have them to reference back after the meeting.
Awesome. Thank you, Phyllis. You could just go to the next slide, please.
Okay.
So this is part of the process and part of the slides that I'm just going to touch on, just because I don't want to overwhelm anybody. But these are the necessary steps when we have our pre-approval, we found the house, we got a contract, that's going to be Anthony, and then I'm able to take over the loan process from there. All right, when we do go through the loan process, I already have 90% of your documents that I already need. What I'm going to do is I'm going to package it up. Me and my assistant, I'm going to make sure everything is together, it's coherent, it's a nice clean package to submit it to the bank, to the underwriter, who's basically their goalie. And they're going to come back and say, okay, this person's good to go. We're going to lend them the money. But, I have 3 questions. What's this variation in a credit report? Do they have owner's interest in this home? And, where did this money come from? Things like that, right? If it shouldn't be anything crazy, for the simple fact that we already previewed this during the pre-approval stage, so I know what to expect. So once we have that, we submit it in. That is the loan approval, the commitment. That's labeled as number 3. I'm skipping around, so bear with me. And basically, that's just telling the parties, hey, we're good to go. The bank likes us. That's something that I send over to Anthony. It solidifies the contract as well, so everyone knows, hey, we're moving forward. You're happy, you got the approval. I'm happy, we got the approval. Phyllis is happy because Joe got the approval. And then during that process too, simultaneously, we're going to order the appraisal. So the appraisal during the mortgage process, that's the one fee you'll pay up front and out of pocket, instead of like your closing costs that get paid at closing. Reason being is it's a third-party company. So we pay directly to the appraisal company. I submit the link and the order to them, but it's you making the transaction directly to them. So, and their licensed individual will come in, they're going to evaluate the house, and separate from the inspection, they're going to make sure that it is of value for what you're buying it for. So they're going to run comparables with the current market and what's in your area, and basically just make sure that you're not overpaying, right? If you bought it for getting it for 600,000 and the appraisal came in at 620,000, I'm not going to tell the other side. I'm going to tell you, we're going to be excited because we're getting the house cheaper. But just another thing to have where you can just, vet the property and make sure everything is good. Those are, do you mind going to the next one, please? And closing, you're going to deal with my friend Anthony over here. I don't want to step on his toes with his process, but Once he does this, he helps you get the necessary things done to be able to clear on his ends. He's going to set up the closing with you, and you'll be able to balance the figures to get you specific numbers for closing, right? Closing costs, remainder of down payment. Again, I'm not going to touch on that much. I'm going to leave it for Anthony. And funding, basically, that all that is after that's all done, you make your signature, sign it over. The bank is going to, there's an attorney in the office for the bank that's going to send the paperwork back to us. We sign off on it, and then you're good. You close on your house, you got funded, and we're all happy celebrating. And then hopefully you invite me to the barbecue that you have. Accepted offer. All right, next slide. I don't really think is going to be much on my end, but that is pretty much the pre-approval process. So is there anything that you think I should add that I didn't touch on?
No, I think you did a
Yeah,
really great.
we-
Maybe just the difference between FHA and conventional.
Yeah, I mean, so the way it works with mortgage lending, so there's different programs obviously you can get, and there are main programs that people look at when they're doing financing, right? So you're looking at the difference between conventional and FHA financing. FHA is governmental financing, where conventional is ran by Freddie Mac and Fannie Mae. Um, main difference, so you know, both of them have first-time home buyer programs. A lot of people have a misconception, just says FHA, government loan, that's what I want to do. It's a great product, but if you're somebody whose credit score is 700 plus, let's say you're 780 credit score, and you want a first-time home buyer program, conventional is going to be cheaper for you. Reason being is that FHA, again, great program. It's geared towards people with lower credit and a little bit of a lower income as well. And basically what it does is it fixes the mortgage insurance that you're going to have for the life of your loan, right? Meaning that if you put down 3.5% down in FHA, there's a percentage, like 0.55% of what your monthly mortgage insurance is going to be just based off your loan size. So it doesn't have to do with your credit score. Whereas if you're conventional, you have a great credit score and you have mortgage insurance, it might be 0.25% of what that is for FHA. If you had a 620 credit score and you went conventional, your mortgage insurance is going to be probably triple what FHA is. So biggest thing to know, and this is just, I say this for a lot of things, it depends, and it's all situational, right? There is no one size fits all. It's evaluating your situation and saying, okay, you can go into program A and we can get you, it's going to look like a cheaper interest rate, but your monthly payment is going to be more because your mortgage insurance. Or B, maybe the interest rate is a little bit higher with conventional, but you have cheaper mortgage insurance. And now we're going to look at the life of the loan, right? If you're in it for 5 years, what is going to save you the most money? You know, is it the cheaper interest rate? Is it the cheaper mortgage insurance? So these are different things I analyze on my end. And then after I review your pre-approval, when we get back on the phone call, this is what I go over in detail, telling you what I did, why I did it, and basically, just filling in the blanks, any questions you may have.
Thank you, Joe.
Of course.
So,
If anyone has any questions on that and wants to just throw it in the chat now so we have it later, so it doesn't, escape from your mind, that happens to me, please feel free.
okay, hold on a second. I don't know where I am now. I got this one. Oh, okay. So now I'm going to introduce you. Hello. Okay, there we go. My thing zapped out of me for a second. Sorry, guys. So now I'm going to introduce you to Anthony Esposito, and we're going to start talking about getting to contract. So one thing before Anthony speaks is you see inspections on the screen. After we get an accepted offer, we will set up an inspection. I will give you, hold on. Okay. I will give you a few inspectors that we could call, help you set up an inspection. And then we'll go through. I come to the inspection, I'll walk through the inspection with you and the inspector to see if anything comes up in inspection that is critical to the offer that we might have to renegotiate and stuff. So Anthony, take it away.
Hey guys, can you hear me? Wonderful. Just wanted to first welcome everybody. Of course, I'm last to speak, which means I'm probably the most important in the group. That being said, I also wanted to congratulate all of you who joined us tonight, because what you're doing right now in this 45 minutes to an hour, whatever it is preparing yourself in a way that most people do not. So you have an absolute advantage when you start this process, and when you get into the process, you'll already know what to expect, and to have that knowledge is an incredible advantage to you going forward. I will say one thing, Joe, you mentioned if there was anything else that Phyllis wanted to add. I want to add one thing before we move on to my job. One thing that
So
Joe touched on slightly, but I want to emphasize, is change. When he runs your numbers on a preliminary basis and gets you pre-approved, it's based on what you've provided to him. So quite simply, if you're leasing a Maxima and your lease is up during the process, please do not go and lease a Mercedes Benz, because those numbers, the two, three, four, $500 a month difference, can absolutely change what you've provided to Joe and bring you from an approved status to a disapproved status. And I'm sure Joe will probably tell you the same thing I'm telling you, but I've seen it happen, because people don't prepare the way you're preparing now, or they're not told, and then I have a problem that I have to fix and clean up. So we're going to avoid that at all costs. Um,
it's a great note. And if it let's say if it's a C-class Mercedes and it's the same payment as the Maxima, then we can get
Baby.
away with it. But any big decisions, any big deposits like that, exactly what Anthony said, I didn't touch on this. It's always just you want to give me a call or a text and hey Joe, can I do this? Yeah, you're good to go. Right.
Yep. And I've seen it. I've seen it with people getting all excited, getting ready to get into their home. They go to Ethan Allen, they bang a credit card, and there's an $8,000 balance that they didn't have 4 hours ago. Also, a very bad thing to do. Don't do things like that until you close. Um, all right, I'm going to jump into where we're at. Phyllis will order or have you introduce you to somebody who will do an inspection for you. These are generally licensed individuals who do a very good job. What I like for them to do is disclose to you as much as possible that as what is wrong with the house and what is potentially wrong with the house. The sellers will generally only fix things that are defects, which means things that are wrong. Okay. If it's a bad wiring, things like that will get fixed. If you have a leaky roof, it will get fixed. If the inspector comes out and says, oh, this roof is at the end of its useful life, it's 18 years old, and the life expectancy is only 20 to 25 years on that, if that roof does not leak, you're not getting a credit. You're not going to get it fixed. It's a functional thing. So that's important to note. The inspectors are generally very good and at running through everything and then summarizing it. I will absolutely put eyes on the summary. I will absolutely answer questions as they come up. And of course, as your attorney, I'll advocate for you for either a repair or a credit, especially when one is required or needed. Um, when we get that inspection report back, there will be a lot of things on it. That's what you should expect to see. There will be wants and there will be needs. We will absolutely have the sellers address all of the needs. Many of the wants, some of them will get approved. Many of them will not, because they're wants. They're not things that are required. Phyllis, if you could jump to the next slide, I'm ready.
Sure.
So once we agree to either the repairs being done or a small credit or credit based on what needs to be done, we'll move on to the contract. The contract will reflect if it's a monetary credit that will be in there. The seller's attorney always prepares the contract. As a purchaser's attorney, I would review that contract. I'll make changes. I'll send them over to the seller's attorney. Generally, most of my changes will be accepted. Some of them will be rebutted. There will be a negotiation as to what's acceptable. We can generally get through all of the requests amongst the attorneys without having to involve our clients. Now, if something comes up that bothers me enough that I don't think is something you should be giving up or even sacrificing in any way, I will absolutely give you a call and say, hey, as a matter of speaking, this is a general thing that this attorney is not allowing me to make towards the contract. Sometimes it's something as simple as, hey, we have a mortgage contingency. Everyone's agreed to it. In the contract, I look for 45 or 60 days. They may want an answer in 30. I would call up Joe and say, Joe, Do you think he can get this approved in 30 days? And then I'd call you as the client and say, hey, I spoke with Cursio and he said, look, 30 days is enough, but he'd like to have 45. I'd say, amongst us, what can we agree to? I would really want to push for 45 or 60, but if you're comfortable doing 45, then I'm comfortable doing 45. And then you would probably speak with Joe and say, hey, can we get this done in 45 days? And that's a window that we can agree upon. If it went to 30, I would probably tell you I'm not in love with the 30-day approval time frame because you need some time to get your stuff together. Banks need some time to underwrite and approve your loan. Um, that's a type of thing that we would involve you in. Now, to that end, I probably can get you a small extension if that's what needed to be done, but I prefer not to. Next, we have where we would go with signing. So in that event, we would have to sign the contract and move forward. When we sign the contract, we would tender a deposit. That deposit could be a regular check. It does not have to be a certified check. In this case, a regular check is something that you can absolutely put through. When you execute and we send the check back, the seller's attorney would then look at it, execute it, and send it back to me. We are in contract at that point. Everything is locked up. Nothing can change. We can jump to the next slide. The appraisal is what's done from the bank. The bank will handle that appraisal. Once they do that, I'm involved only to the point where I want to make sure that the house should appraise for what you're paying for it. If it comes in under, we have a discussion. We have to figure out what we're going to do, if there's going to be a negotiation as to the price. If it comes in over, we all smile and move on.
Right.
At the same time that appraisal is ordered, I'm going to do my due diligence in getting you the title insurance. We're going to order a title report. We're going to make sure that as part and parcel to that title report, there are no liens, there are no judgments, there are no things that would hold you up in a way that would be something that's an impediment to you getting marketable and insurable title. Those are two terms that as attorneys we throw around a lot. Marketable and insurable are two things that we have to make sure your property is, because I want to make sure you can get title insurance so that you and the bank, which requires title insurance, have it. But more importantly, I want to make sure that your property is marketable at all times going forward when you turn around and try and sell. Phyllis, you can jump.
Yeah, so when the appraisal's ordered, they'll call me. I'll show up and meet the appraiser, and I'll bring the same CMA that I use for you to show you what you should offer for the house. I will bring those comps with us. They do their own comps as well, but sometimes us bringing the comps will help them, solidify that this is what the value of the house is worth.
Yep.
With that being said, with the title, Anthony makes sure like nothing comes up like infringing fences and stuff like that. And
And part of that is when we order a survey, and that's why we order a survey. The reason why we order a survey is to make sure that the property lines are what they should be. And that's always done as a matter of course and part and parcel to my completing the title examination.
And to be honest with you, I've worked with a lot of attorneys. I've been working with Anthony for quite a few years now, and he is like no other attorney I ever met, because if there's a problem with a fence or something, he gets up out of his office and goes and takes a look at it with his own eyes to make sure that what he's looking at the paper is what really is there. And it saves us a lot of trouble and going back and forth, because then I could call up the agent and say, listen, you need to talk to your seller because of this.
But truth be told, I like getting out of the office. Have to spend time behind my desk, but going out into the field is not something I'm afraid to do. And I find that it's very helpful because when I call up the other attorney, who generally doesn't leave their desk, and I say, hey, we have a problem with the survey. This is what it shows. And they're going to say, well, what does it show? I'm going to say, well, it shows that there's a problem with the fence. It's not where it belongs. And I'll tell you why it is, because there's a tree in the way. And the first question I always get is, well, how do you know that? And I say, because I was there. Would you like me to send a picture that I took on my iPhone over to you so you can see what's going on? And generally, the whole discussion changes pretty quickly after that. So, with experience comes the habits, and some of them are really good, and you try not to develop bad ones. This is something that, I enjoy doing. I've practiced law for quite some time. Don't let my hair fool you. But with that being said, um, this is something I enjoy doing. This is a happy time for you. There's going to be some stress involved in this process. It's like anything else in life. Anything that's worth it requires some work. You guys already are on the right foot, started to put some time in, you're doing what you need to do. This will work out. Phyllis, I guess you could jump to the next slide because it's going to talk about closing. I would think it is.
Is it?
That's Joe's underwriting slide. I'm not talking about that. Let's move to the next thing. I did speak
Yeah,
about
'cause
no
we
major
did talk
purchases.
about no major purchases already.
Yes. You will do a final walkthrough. I am
Yeah.
not there for it, but what you will do is report back to me and say, hey, when we get to the table, I'm always going to ask you, hey, how's it going? Did you do your walkthrough? You're going to tell me yes. And I'm going to say, good, how'd it go? And generally, I'm going to get awesome. Everything's great. If something comes up, we'll deal with it at the table. Usually it'll be a credit. Sometimes it'll be something that needs to be done. We will figure it out before we close.
Yeah. Excuse me.
As part of that
if you-
preparation for closing, about a day before, sometimes 2 days before, I'm going to get numbers from the bank. They're going to tell me not what you borrowed, because I know what you borrowed, that's your loan amount, but what you have available to spend after your expenses for the lender and their fees and all the stuff that you didn't pay for are deducted out. When I get that number, I will see what bills you have. You'll have a title insurance bill. You'll have a legal fee bill. You'll have some small ancillary bills as part and parcel to the closing. I will have your bank cut all those checks for you. Why? Because I only want you to bring one check to the closing, not 4, not 5, not 6, not 8. Because every time you bring a check to closing, there's a chance that the chances of something going wrong increase. If we do 2 checks, it's double. If we do 4 checks, it's 4 times as likely something will go wrong with those numbers, or with a payee on a check. And when we have certified checks, which is what we deal with at closing, you'll have to go back to the bank the day of closing. I really don't like when that happens, and I do everything I can to make sure it doesn't. So that's why I do it the way I do it. One thing I will say, Phyllis has been in the room when I do closings. Joe has been in the room from time to time for some of my closings as well. I will always ask my clients, whether you're purchasing or whether you're selling, do you understand where your money went? And if the answer is not a clear and concise yes, we will sit at that table until I don't care if everybody else leaves. We're not leaving until you know where your money went. This is probably the biggest and most substantial purchase you're going to make in your entire life. With that being said, you have to know where your money went. It's easy to see your loan amount. Everybody gets confused when they see, oh, I paid this, I paid that. Sometimes I'll get a question, hey, why did I pay the seller's realtor? No, you didn't pay the seller's realtor, but they requested that their realtor be paid with the money that we're bringing. So you've got credit for every dollar we sent over to the side of the table. Maybe one of those checks is their realtor check. So we will not leave a closing until you know where every dollar went as a purchaser. Phyllis, next slide if you're ready.
Okay, I just want to jump back to the final walkthrough. Once we get the clear to close, we will set up the final walkthrough. I will come with you for the final walkthrough. You'll check sinks, you'll run faucets, you'll flush bowls, anything that we ask to be fixed, we'll check on that. And that's when we'll say, okay, everything's great, everything was done. If it wasn't done, that's when I'll call Anthony on the way to the closing saying, this is what's going on and this is what we need to address when we get there. So I just wanted to just jump back a little bit to let you know how the process goes. And now I'll go to the next slide. You're on mute, Anthony.
So, by the way, that's my least favorite phone call, one of my least favorite phone calls in the world to get because something went wrong. However, when it happens, things do happen in life. We'll deal with it. We'll get it addressed. at the table, and we'll make sure that what needs to be done gets done. I basically told you about the closing, how it works. You will be asked to bring photo ID so you can prove who you are. Your social security numbers, I'll know it before closing, but it will be there. There will be some documents that require your signature. Actually, there's going to be, as a purchaser, there are plenty of documents that require your signature. I will say Mr. Cursio worked with a bank that requires the least amount of documents I've ever seen in my life. And that is such a blessing, because when we're at the table, I'll explain to you every document in a very limited capacity, because I can't sit here and explain to you what's on 18 pages of your mortgage. However, I will tell you what your mortgage says, in summary, how much you're borrowing, who your lender is, when your first and last payment are, and things like that. At the table, there are three super important documents. One is your note. It sets apart the terms, your interest rate, your first payment, your last payment, things like that. Your first payment letter, super important. Why? Because it tells you exactly what Joe said before. It tells you what your principal and interest is, tells you what your hazard insurance is, tells you what your taxes are, and it tells you what your monthly payment is going to be and when it's going to start. You would want to know that, because that's when you start making your payments. So those are the most important documents you're going to sign at the table. Next slide, please. We're going to deliver our funds. We're going to sign our documents. We're going to deliver our funds. The bank is going to send their funds. We're going to have a deed at the table. It's going to go with the title company to be recorded along with the mortgage. At the end of the closing, you're going to get your keys. Sometimes at closing, you don't get your keys because the sellers require an extended period of possession. Sometimes it's a few hours, sometimes it's a day, sometimes it's up to 5 days. We will know that before we get to the table. I will make sure it's okay with you. We will figure it out. We will hold an escrow to make sure that the people leave when they say they're going to leave, and that premises are in the same condition that you saw them in the day of the closing. And that's basically what goes on. Anything else, Phyllis?
Yes, and once you get the keys, you will definitely call Con Edison and call National Grid right away, because you want to make sure that they switch everything into your name, because if you forget to do it and they shut it off, it's going to cost you $400 to have them put it back on. I've had that happen to one of my clients, and it was not pretty because they forgot to call up. So just wanted to make sure I stress that. Okay, so we're done. After closing, it doesn't stop there. We're always available for you. We're there for any questions you may have, any anything. If you need repairs done and you need a referral for somebody, a plumber or anything, you just call us and we're always there for you. Does anybody else have anything? Joe, do you have anything else you want to say? Anthony? Okay, so
No.
why should you hire me or my team? When you're looking for houses and you're looking to work with a realtor, you want to make sure that the realtor's full-time versus a part-time realtor. A full-time realtor like me, I'm always there to communicate with you. I'm available, even if I'm at an appointment or something, I'll text you like as soon as I'm done, I'll give you a call, and chances are you'll get a call from me within that hour. Part-timers, they work full-time jobs usually. It may take you a day or two to get in touch with them. So they're not that readily available. If there's homes you want to see and they have to work, they might send another agent with you. I'm going to be the agent that comes with you on all the showings. So this way I could see the house with my own eyes and guide you the right way. And I have a great team support between Joe and Anthony, home inspectors. I at my office, I have a lot of transaction coordinators that take care of all the paperwork so that they make it very easy for me to do my work and tend to you. And I'm very good with the market. I know exactly where the market's going. If we walk into a house, I'll know if we're going to get off like multiple offer situation or not. And I could, help you through that. And I give you the hard truth. I'll tell you exactly what I feel about the house. Because if I think the house isn't for you, I don't want to sell it to you, I'll tell you why. Because that has happened before. Um, so I'd like to open it up now to any questions that anybody might have for either me, Joe, or Anthony.
Hi guys, I just have one quick question. First of all, the presentation was great. I learned so much. There were other things that I did want to ask, but you guys provided the answers, so I don't need to ask those questions. So that's even better. I love that. But really quick, so I know given the different variables that come into play, there's no specific timeline, but on average, what does like how long could it possibly take? Like what have you seen like on the short end and on the long end?
As far as finding houses, I've
Yeah.
I've showed one or two houses and got somebody to buy because they fell in love. And then in a different market where there was a lot of inventory, I showed as much as 150 homes, So it depends on what the market's looking at like and what kind of particular house you're looking for, and what the inventory is. If we have a lot of inventory, you have a lot of choices. If we don't have a lot of inventory, then you may be limited to what you're looking at. But with that being said, I do have buyers right now that are looking for two-family in Bay Ridge, looking for ranches in certain areas. And what I do is I pull up those houses and I start making phone calls to see, because there's such low inventory. I call up everybody and say, are you thinking of selling? Because I have a buyer ready, willing, and able. So it could go like that as well.
Thank you.
You're welcome. Anybody else? I see
I
something in the
see. Yeah,
chat.
there's a question from I think Eric and Jennifer. How are
Our
closing costs?
closing costs calculated.
Yes, yeah. So I'm gonna start that and I'm gonna ping pong it back to Anthony. Um, so closing costs. So within the boroughs, right? If we're talking Staten Island, right within obviously the five boroughs, closing costs are different than if you move to Jersey or if you're buying Westchester. Reason why I say that is because, well, let me back it up. What I like to tell people is prepare for around 4.5% in closing costs, right? Going off the mortgage that you're going to pull. Between 4 to 5%. Reason being is because 2% of it is tax that you pay to New York State because you're taking out a mortgage, right? New York just loves to tax us. So that's 2% right there. And what would you say? Title fees, title insurance, title bill, all that is roughly around 1% or so. Is that fair?
I think that's a fair number.
Okay.
Now, understand the title bill is mostly your mortgage tax. So if you're borrowing, more money, your title bill is going to be more. So I usually say 2%, Joe, is what I like to go with because your mortgage tax is usually almost 2% of what
Yeah.
you're borrowing. So again, if you're borrowing $800,000, you're going to see almost $14,000 in mortgage tax, and then you factor in a few of the title fees that go along with it. So 2% is generally the number I would go with on the title side.
That's with using the mortgage tax, you're saying, or adding?
That's with that. If I factored in the mortgage tax, yes.
Okay. Yeah, makes sense, right? So you have your, and like you said, the title fees, that's some stuff that you're pulling to make sure that there's no liens or anything against the house.
That's exactly why that becomes so important because without
Correct.
those searches, the report can't be generated because we don't know what we're up against. The bank won't close because they don't have their interest insured, and without insuring their interest, they're not going to lend the money.
And then a portion of your closing costs, which I like explaining this one because it's not actually a cost to you. You're paying out of pocket, but it's your money, is an escrow account. So what I was talking about prior to about your monthly payment, your principal, interest, tax, insurance, when you're going to pay your tax and insurance with your mortgage, you're going to create an escrow account. This escrow account is going to be an account that holds your tax and insurance. It's going to be put together at closing from the bank, and basically what you're doing is you're prepaying it, right? So we pay taxes quarterly, right, within our county, in Richmond County. So let's say at closing time, bank's going to say, all right, we need 3 months of taxes put in this separate account so we can go ahead and start prepaying it for you. This way, you're never late. You never have to deal with a late tax bill from the state. So that escrow account that you have, let's call it 1% or whatever the loan amount is, give or take, right? Just depends on the taxes and the insurance, usually lower than that. I would say closer to the 0.5%. That's your money. So if you did go and sell the house or refinance, that you get that money back. So anytime you get a mortgage statement every month, you're going to have an escrow balance, right? It might be running around $3,000 or so, right? Whatever your quarterly bill, leading, give or take a month, that's what it's going to be. So your money, but just good rule of thumb, I like to use 4.5% off of whatever the loan is, right? Let's say 500,000, just to give you a good range. I think that's definitely a good number. I'll always say, prepare for it, 1,000 or so, but that is definitely a good rule of thumb. You have any questions off of that specifically?
Okay. Does anybody else have anything else that they want to ask?
The only thing that I'm going to add is that, Joe, you make an excellent point. The banks collect those escrows for taxes and insurance because it's in their best interest to do so. It makes it easy for you because you balance your payment over 12 months. But the reason why they do it is because, number one, if the taxes don't get paid, the taxes become a lien against the real property, and that's contrary to the bank's interest. That's number one. Number two, they want your money to pay the hazard insurance when it becomes due, because if for some reason there is a lapse in that insurance and something goes wrong, the bank is not covered. So believe me, they're going to do what they need to do to protect you and their own interest, and those are two examples of it.
Thank you. That was very informative. What are interest rates at now, and do you see them trending in a certain direction going forward?
So that's a great question. And before going into where they are right now, one thing I didn't actually touch on is interest rates. So interest rates, so you see where market is and what the Fed dictates rates, and then we kind of see how it translates into mortgage interest rates. Now, one thing that's super important to know when you're getting quoted interest rate or shopping interest rate is you qualify for the interest rate based off of your scenario. Now, what I mean for that is, let's say market rate is 6.5%. If you have top tier credit, if you're putting down a nice chunk of money with your down payment, if you're buying maybe a single family over a two family, and then depending on which state you're going into, what program, you might have a rate that might be a little below market interest, right? Maybe it's a 6.375. Now, if it's the same scenario, but now let's say your credit's 660, you put down 3% and you're buying a multifamily in New York, your interest rate's probably going to be 0.25% higher than whatever the market rate is. So a reason again why I say that is just because I see a lot of info out there and a lot of people how they market things, whether you're on social media or you're getting postcards in the mail. People just show you a rate. They don't show you what that rate means. And a lot of times you'll see it too. Let's say you get a postcard in the mail, I get them all the time, where it says an interest rate and then it has an APR, and then APR is higher. Reason being is that APR, it's what it is, it's taking all the costs associated with the loan and giving you a rate. So when that rate is higher, 9 times out of 10, they're charging you to reduce that interest rate. Along with that too, some people might tell you, hey, this is your interest rate, this is what you qualify for, but they're not telling you what you're paying for. Now, you always have the option when you're locking in your interest rate to take a higher interest rate and potentially get a credit from the bank, right? Because you're paying a higher interest, so they're giving you a little bit of credit from the interest. Or you can elect to pay no points and have the market rate. And third option, you could take a lower rate and you pay upfront interest at closing. Now, not necessarily good, not necessarily bad. As long as you know what's going on, it could be a great thing. And how we determine if it is if you're able to pay $5,000 to reduce your interest rate by, 0.25%, and it saves you $150. What I'm going to tell you is we're going to divide the $5,000 by 150, right? Because that's your savings. And whatever that calculates to be, that's how many months it's going to take you to break even. If you're going to stay in that loan or live in the house longer than that term, then paying the interest makes sense. If you're not gonna, I'm not gonna suggest that you buy down the interest points. Now bringing it into today's market, so we follow typically when you see, the Fed is reducing interest rates, they're reducing by 50 basis points. It's great, right? Great for economy. it doesn't directly correlate to the mortgage world, right? So the last when they had the rate cut 50 basis points, 2 weeks prior to it, interest rates for mortgages came down a little bit, right? Because they're baked into it. But once the day came where they reduced it by 50 basis points, interest rates went right up for us. Reason being is because it isn't specific to mortgage lending. It's more to short-term lending, bank to bank lending, right? So be careful what you read because there's a lot of misinformation out there. But one of the things we follow is the treasury yield. So the 10-year treasury, which from Friday to now has been doing much better than it has in the past month, 2 months, which is I'm thankful for. That's where we follow. So as that's coming down, typically interest rates are getting lower. So from what I've been seeing the past 2 months, we're already getting better. And my personal opinion, I don't talk politics, and whether you like, you don't like, whoever it may be, whatever, our president now is a real estate guy, right? So just based off of that alone and everything else that you read, my opinion based on that is that he's going to create more real estate transactions, whether it's helping to reduce the interest rate, that, the Fed's controlling, or some, anything with any kind of grants or home prices, things like that. I think it's going to go in our favor. With that, what I would say is I have a lot of people that say they want to wait. They want to wait for the interest rates to come down, and which would be great when they come down. But just realize one thing, right? If you buy a house today at 500,000, and let's say interest rates as high as 7%, the interest rates come down to 5%. That $500,000 home, what does it mean? It means that more people can afford that $500,000 home. So I mean, more people are out there putting bids on that house. So that house might go for 600,000, right? And it's the same payment as someone had as a 500,000 at 7%. But the catch here is that the person who bought it at the cheaper price and the higher rate, once the rates come down, they can refinance with the loan. They wrap in closing costs are much cheaper than a purchase. They wrap it into the loan, and they're going to have the house price that they bought it for, a cheaper interest rate, and most likely their value in the house is going to increase. They're going to gain equity. Whereas if you buy it at a premium at a cheaper rate, what happens? You're not going to be able to refinance that. It's going to take you some time to gain some equity. Reason why I say that is just because I don't be afraid of what you see out there with the rates, right? Rates right now, we're mid 6 to high 6s, right? Depending on your scenario. There's a first time home buy program that's on right now that's actually at 6.125 if you fit into that category, which is amazing. But I mentioned that just because, don't be afraid of it. If it fits into your monthly budget and the monthly payment is good, then I suggest you jump at it. If it doesn't fit into your monthly payment, regardless of what the interest rate or the purchase price is, don't do it. It's got to make sense. So that was a long answer to really go over the interest rates, but interest rates are very it's a fun topic for me because it's a very common question, and a lot of people that don't know as much during the process, that's the first question that they're asked because their father, mother, brother, uncle said, "Oh, what's the interest rate?" No, don't do that. But these are the reasons why we go over stuff like that. Thank you. Appreciate your kind words.
I'm glad you enjoyed this. Is there any other questions? Okay, with that being said, then I'm going to thank everybody for joining us. I also want to let you know that besides selling in Brooklyn and Staten Island, I will be going to get my Jersey license soon. So as with Anthony and Joe, I could handle Jersey soon. So if you're thinking of that, think of me as well. If you'd like to book an appointment with me or Anthony or Joe, you could go on to my www.phylliscangro.com and go into the calendar and make an appointment. With that being said, I want to thank everybody for your time for coming on here, and I hope that we answered all your questions and made you feel more comfortable about the buying process. Have a good night.
Thank you, everybody. Have a great night.